if you have a rental property, you may at some point ask yourself, is it time to sell this house? And I'm going to go over some numbers to help make decisions like that. Hey, I'm Rebecca. Thanks for joining me on the Mandalorian Way, where I am a mom. Sometimes I have kids running around in the background or dogs in the house because I'm just a real person looking at how to empower myself with my finances and money and share what I know. Today, I want to talk about how to look at the question of, if I have a rental property, is it time to sell? Should I keep it? And how do I look at those numbers? So I'm going to go into my computer and take a look at some numbers. All right, so here I am, because I just want to do a slideshow. We're looking at numbers, and it's easier to see it than imagine it. Should I sell or hold on to my rental property? Well, there's some things to consider. First of all, what cash flow? Is it a lot of money coming in, a little money? And how do you judge, is it a good cash flow? Long-term appreciation. So when you hold on to property, historically, prices of real estate have risen and risen and risen. There's some little bubbles and bobbles along the way, but historically, over time, your property is going to be worth more after 5, 10, 15 years, whatever your long term is, than it is now. Things to consider also are taxes, and how do they impact whether you have a good idea to sell your property or keep it, and how to consider taxes. Highest and best use of equity and capital. I think this is a really big one, because sometimes when houses appreciate a lot, they end up with a lot of equity stored in them that's not really being used at its highest and best use. And then, of course, personal considerations, like, do you want to be a landlord? Do you love being a landlord? Do you want to hold on to this house for your grandkids to live in? Starting with case study number 1, market value. So the market on this, according to Zillow, this house I have as in my case study, is $513,000. The note remaining on the house is $117,000. The principal, interest, taxes, and insurance paid out per month on this house are about $1,450 a month, and it's currently rented out at $1,835 a month. So it looks like there is a cash flow of about $385 a month. Is this the best use of the money? All right, first of all, the cash flow, and you hear a lot of like real estate people say, oh, this is a cash flow. It never takes into account the maintenance, the repairs, vacancy costs. Sometimes you have to repaint. You have to pay a realtor to release. It doesn't take into account of that. So sometimes you're in a negative cash flow. And in this particular case, there is a lot of equity tied up and not working. So is this the best use? Because if you look at it, the market value is over $500,000, and the note is just about $117,000. So there is a lot of cash tied up in this. This particular house has had a lot of appreciation. You can kind of tell because the note is so low and the market value is so high, and it's been held for over 14 years. So let's look at possible equity in the house. Sales price, $513,000, less closing costs of an average of about 10%. It's a good ballpark figure. So that you'd walk away from closing. No, you wouldn't walk away from closing, pardon me. After that, $461,700 minus the payoff on the loan, and you'd end up with $344,000 approximately. So you'd end up about $344,700. Would you? But wait. There's taxes. Rental property is not tax exempt for sales profit. So if you make a profit, you're going to pay some capital gains taxes. Then there's depreciation recapture, and that's a little complicated. When you have a rental property and you depreciate it to save on your taxes during the time that you're holding, when you sell the property, the IRS wants a little bit of its money back. And there's a lot of rules and formulas for this. This particular case, and I would say ask your CPA for the details. I'm going to just assume 15% capital gains tax to make it easy. So possible equity, we already did the sales price minus the closing, minus the loan payoff, minus about 15 in capital gains taxes, net on sale, $299,100, close to $300,000. Not bad. So that's how much money is sitting, not doing a whole bunch of work on this house. So what if you took that amount of money that you walk away from closing from and after paying taxes and invested at 8%? You'd get about $23,009 a year if you invested it at 8%. At 10%, it goes up to $29,000, nearly $30,000, and at 12%, getting close to $36,000. And if you wonder, like, hey, I can't get 8, 10, or 12, I'm going to say I get it on all my investments at least 8% and a lot of times over 12%. I have researched things. I've educated myself. This is why I'm passing this on to you. But yes, those are actual, real, probable numbers if you know what you're doing. Now, this cash flow that we're getting, and I have in parentheses because you still have to pay maintenance and stuff, is about $4,620 a year compared to $30,000 as. There's also a way you can capitalize a little bit more on that equity through a 1031 exchange. So that is when you sell the property, you trade up your existing investment property into something similar, a like kind. So it's got to be real estate. You can't go out and buy fine art with the money and say it's an investment. It's like real estate to real estate. You can't take any money out at closing. It goes through a broker and it goes into like an escrow account, because what we're doing this is to push taxes along for the future. So instead of pulling the money out, paying taxes, and now you're free and clear to do whatever you want with it, you're pushing the taxes along into the future and reinvesting it into some kind of real estate. There's very specific rules and time frames. It can be tricky. You definitely have to work with a professional. But what you get out of it is no taxes. So with this case study, Brainy Money, net on sale with no taxes, about $344,000. And just to have easy math, 10% a year, $344,000 at 10% a year yields about $34,000. All right, pros to keeping this house. There could be more appreciation. This particular house is in a hot market, in a hot area, in a hot state. Could keep on going up. You could also stay with this house and do a cash out refinance to take some of the money out. Now then you'd have more principal and interest that you're paying on to be able to use that money, and your payments would go up, so you may not have any cash flow, so your rent would have to go up as well. And sentimental. Maybe you want to keep this house for your grandkids or reasons your firstborn child was born in it. I don't know. Everybody's personal considerations are different. Cons to keeping this house is always upkeep costs. Now this house is starting to need more and more work. It's been a rental property now for about 8 years, served very well, but it takes its toll. And then the cash flow cost, which is the biggest thing. So maybe it tops right now $4,600 a year netting a cash flow versus an average. If you pulled out the money and even paid taxes on it, you might be able to see $34,000 a year, and that might be equal to some appreciation that you're getting in that house if you kept it. Case study number 2, because not everything is created equal. This particular house, the market value $210. The note on the house is $110. Principal, interest, taxes, and insurance about $950 a month because it's in a place where the taxes are not as high, and it rents out $1,435 a month. This looks like it realizes a cash flow of $485 a month. Is this the best use of the money? All right, there's still in this house a lot of appreciation possible. Even in 2021, where it is, we've had a huge upswing in house prices that may be coming down a little bit, but for the most part, they're up. And it's hit some parts of the country quicker than others, and this is in a part of the country there's still a big room for appreciation. There's still some equity tied up, maybe $100,000, but as opposed to like $300,000 in the other one, and no major repairs are needed at this time. So possible equity: sales price $210 less the 10% closing, that's $189 minus the loan payout $79,000. Let's see, there's taxes though, right, on that? Well, yes and no. So the sale of your primary residence is tax-free up to $250,000 for a single person and $500,000 for a married person. So proceeds that you get from profits you get from selling your home, as your homeowner, are tax-free up to a certain amount. And the qualification is you have had to live in that house for 2 of the past 5 years. So in this case, the woman she's my client that's looking at, should I rent this property out or should I sell it, has been living in it. So she would not have to pay tax. So she could walk away with the $79,000. So say you take that $79,000 and you don't spend it, you invest it at 8, 10, and 12%. You're between $6,300 a year and almost $9,600 a year, versus the cash flow $485 a month would be $5,820 a year. So even at the at the lower end, it's still higher, but it's not that much higher, and you're missing out on appreciation. So let's think about the pros on this one. Pros to keeping: more appreciation, and there may be a lot more, and that might offset what cash flow you could increase by selling at this time. She still has time to rent it out about 3 years before being taxed on the sale, because again, you have to live in it 2 out of the 5 previous years before you sell it. So those 2 years, once she moves out, she's got 3 years where she could rent it out and still be able to sell it tax-free. House is in good shape. It's in a good area. There's not that much difference in the cash flow. And then tax benefits while owning and renting out. That's when you're looking at the depreciation. So your annual taxes might be lower while you keep the house if you go through the depreciation and take out what you can, the benefits you can by owning that. Cons to keeping it: there's always going to be maintenance and the rental costs. Sometimes they have to come out of pocket. You have to become a landlord, and maybe that's your bag, baby, and maybe it is not. And then the cash flow costs a little bit less keeping it comparatively if you took the money and invested it. And the other thing is, what I will say, once you have liquid money, it's a lot easier to move around. Houses are not liquid assets. So I should have put that in there, but they're not liquid asset. So if you're needing money to be able to move and shift around more easily, maybe being a landlord is not your thing. So recap, things to consider: what's the cash flow looking like? How much money is coming into your pocket? Appreciation. What's the growth in the market to up the prices and increase your wealth, like your wealth building at that point? Taxes. What do taxes look like to you? Repercussions of selling and paying taxes, or holding and reaping some tax benefits while you are a landlord? Is this a best use of the equity? And there's so many scenarios. I'm just putting a couple out there to get wheels turning about how money might be best used. And of course, your personal considerations, and do you need to have that money liquid or not liquid? Anyways, I'm Rebecca. Thanks so much for joining me. I love going down and doing math, numbers. If this is your bag, I'll do more. Leave comments, let me know, subscribe, and I will catch y'all on the next one.